All right, so we just got done having a very, very good week in the markets. S&P up, I think, just under 4%. The NASDAQ was up over 5%. So, like I said last week, near-term bullish, that prediction is right on the money. Medium term, I'm still skeptical, although like I brought up earlier, I think it depends partially on the near-term economic data. That definitely is going to be the most important. But I think that if the S&P can break its recent high, then that would point towards at least near-term bullish. And given we're heading into a Fed cutting cycle, I fail to see, at least where we stand right now, any significant downsides in the markets. Now, again, we could easily go down 5, 10, 15%. I could see that for sure. But 20%, 30%, like a lot of people are predicting, I don't really see that, because the economy definitely isn't great, but on the flip side, it's not that bad. Like, at least from what I can tell, it's not that bad. We didn't have a crazy busy earnings week by any means. But if you look at the markets, it was the growth side that won, or for lack of a better way of putting it, because the NASDAQ outperformed, the SPY and VOO outperformed the equal weight S&P. If you look at mid caps and small caps, those were both up about 2.5% to 3%, so less than the S&P. The equal weight index was up about 2.7, I think. So that's something that kind of flipped the trend, and I still am skeptical of the large cap growthier names over the next short period of time, because I think a lot of those names still have overextended multiples that can only expand so much. So that's something I would definitely look out for. That I think that we probably do test that all-time high, but I'm still skeptical whether or not we have seen the largest pullback, at least based on a percentage, yet this year. I'm still not convinced we've seen that, and given that, I still would be treading water lightly here. In fact, I'm about as conservative. Again, that compared to the average person, that's still aggressive, but I'm about as conservative as I've been for a while this year, because given we're up so much this week, we're basically about 2%, at least on the S&P, from the all-time highs. I'm treading quite lightly. So that's basically what's going to happen. I still think my prediction is going to hold true. I still think over the next few months or so we see a more extended pullback. I don't think it's anything crazy, and then we close the year up. I could be wrong there. I definitely could be wrong, but I still like that prediction. If we look at Bitcoin, Bitcoin was basically flat on the week, which honestly, in some ways, it's kind of good, because there's a lot of people out there that they think that Bitcoin is, it's just pretty much the same as the NASDAQ. And on a week when the NASDAQ was up, I mean, what percentage of weeks is the NASDAQ up? 5%. Like, that is an extremely low percentage. The Bitcoin is flat. In fact, I think it was actually down a little bit, at least at the time of me making this. So that idea, I think, is stupid. I think that idea only exists because there's some traders that seem to buy into that philosophy, and the traders are the ones that drive the short-term price movements. This from Bitcoin Magazine, CNBC, Morgan Stanley allowing their advisors to pitch clients Bitcoin ETFs. If you look at the Bitcoin ETFs over months period, they're still net buyers. They are still net buyers. If you look at the whales are still net buyers. So even though the price is down over the last month or two, the people that are going to control the price over the long run are still net buyers. So I still think we're going to see a massive rally in Bitcoin over the next six to 12 months. There's probably going to have to be some catalyst. It could be Trump getting elected and doing something good, or who knows. A lot of times it comes out of left field, but I think that something's going to happen that's going to drive Bitcoin way up. Like we're going to see it be at like whatever 60,000 US, and then a few months later it's going to be at like 120. Like I think that's probably what's going to happen. When it's going to happen, is it going to happen? I really don't know. That's just what I'm predicting. So let's get into some the earnings from this past week. There wasn't actually a lot of companies, so this is going to go by pretty quick here. Barrick Gold released on Monday, I believe. They did beat earnings and revenue. Obviously, with gold being basically at an all-time high, they did really good. I don't really talk a lot about gold just because I think as an investment, I think Bitcoin's superior, although I'm not necessarily a Debbie Downer on it. And I mean, if you look at gold, it still hasn't outperformed even stocks over the last 10 years. So, and I think it's actually hardly outperformed like junk bonds and stuff like that. So, gold, I'm still a little bit skeptical on. I think that people are going to run somewhere from inflation and overarching, tyrannical governments, for lack of a better way of putting it. And I think that people will flock to Bitcoin. They'll also flock to gold. So I'm not necessarily bearish. I just think Bitcoin's a better option. And not only that, I think that if you're going to hold gold, it kind of defeats the purpose to hold. I mean, I would say you probably want to hold some stocks and ETFs and stuff, but it kind of defeats the purpose. Like it's like buying the Bitcoin ETFs. If you're an institutional client, yeah, it's really your only option. But if you're the average Joe, you have no reason to not just buy Bitcoin. Like there's virtually no downside to it, and there's virtually all upside. So when it comes to gold stocks and stuff like that, I don't think they're necessarily the place to be. The place to be probably would be your physical gold. The problem with that is, well, where do you keep it? To buy it, you need to pay like a 10-20% premium. I remember looking into buying some like 3 years ago. Like it would have been almost perfect timing. I think it was at like 1,800 Canadian. And the problem was the premiums were like 10-20%. You were paying like the price was 1,700 an ounce, and you had to pay 2,000 to get your hands on it, which isn't necessarily the end of the world, but you ain't doing that with Bitcoin. You're paying a spread, but it's what 1-2%. So that's kind of my spiel on gold. Home Depot released. They beat earnings, missed revenue. Home Depot is a decent barometer on how the economy is doing. I don't have a position. I would probably take a position if it ever was for the right price. Obviously, it's a solid company. It's very well established. It's a fairly well recognized brand. Right now, it is a little bit below. I mean, its historical price to free cash flow, but not its historical PE. I think a 24 PE and a 20 price to free cash flow is too expensive for a company like this. Yeah, you get that large cap blue chip stability and the brand, but I don't think the growth is going to be there to justify a price this high. I would wait for it probably to come down like 10 or 15%. Like if you could get it for a PE of like 18 or 20, I guess that would be more than a 10% pullback, but at least based on current earnings, then I would probably buy it. So we're looking at probably like below 300. Although, again, it is a company that if it was the right price, I definitely would dip my toes in. Franco-Nevada, they released pretty shaky earnings, and I think that's largely due to copper, the price of copper being down recently. I do still like copper as one of the better commodity plays over the next decade or two because, number one, I think it's a complete pipe dream to transition towards electric vehicles in the timeline that politicians want to do it. However, we are going to become more, for lack of a better way of putting it, electrified as a economy, and that's going to mean that we're going to need more things that conduct electricity. And wouldn't you know it, copper is one of the best things for that. So I do like copper. I prefer Southern Copper, though. I think it's a little bit better company. I think that it's a better option compared to this. It's pulled back a little bit as well recently. I do have a position in Southern Copper, although my cost position is like $80 a share, and I think it's like 105 or something like that right now, 104, 103. So I'm up quite nicely on that. Again, if copper, if copper, if these companies come down even more, I would definitely take a larger position because I think that's just a no-brainer. If we see a deeper recession than expected, they probably will pull back more. So definitely want to keep an eye on there. Hut 8 Mining, this is one of the Bitcoin miners. They actually released, they actually beat earnings. They were up. Actually, looks like they were about flat on the week. They're technically still earnings negative, but again, they jump around quite a bit due to Bitcoin's obvious volatility. That's the main reason that I watch them. Walmart. Walmart released good earnings. They actually raised guidance. They were up quite nicely on that news. Let's see how much they were up here. They were up 7% roughly on the week, so that's pretty crazy for almost a $600 billion company. And again, given they also raised guidance, that's one of the reasons that I'm kind of skeptical we're going to see a deeper recession or some major economic issue, because when you have a company like Walmart that's releasing good earnings and raising their guidance, I mean, that's where your lower and your middle class people shop primarily, is a place like Walmart. And I mean, I go to Walmart sometimes too. I'm middle class, so not that I'm looking down on anyone there. And that is why, like I said, that I don't think we're going to see a major economic. People are calling for we're going to have a 30%, 40% pullback in stocks, and we're going to have this major recession. And again, obviously, it's possible. It wouldn't be the craziest thing to ever happen. I'm just kind of skeptical of it happening. The next one is Applied Materials. They release good earnings. I do have a position in this company. I really like this company. They probably are bordering on expensive where they're at right now, however. They are above their historical valuations, but I don't think they're crazy. I mean, a 25 price to free cash flow, a 23 PE, I mean, that's not that much different than Home Depot is trading, and I think they're going to grow a lot faster than Home Depot is. So I think that they're probably about fair value where they're at right now. I think they pulled back to around 180 recently. I picked up more of that recently. Yeah, they actually went below 180 briefly. So I would say probably below 190 roughly would be my for sure buy point. Below 180, I think that's starting to become a no-brainer. But probably about fair value, maybe a tad overvalue where they're at right now. Deere actually beat earnings and revenue. Again, another example of the economy. I think it's doing okay. It did sell off a little bit on the week, which is a little bit surprising. But again, that stuff does happen sometimes. AIT, this is another company that I started buying recently. They beat earnings and revenue. They were up on the week. I do really like this company. I do really like them. I think that they're, again, these small and mid-cap names are the ones that I've been really looking out for recently, because I think that's where the value's at right now. If I look at this company, they're below their historical PE by quite a bit, and they're slightly above their historical price to free cash flow. So this is a company that I think you can buy right now, in my opinion. Obviously, my opinion. Very solid company. There's really not a whole lot not to like here when it comes to this company. I don't think you're going to see insane growth necessarily, but I do think that it's a market beater. The last thing I wanted to bring up here is the mock portfolio. I have been making some moves in here recently. Obviously, the main thing that I do here is cash secured puts. If you can sell cash secured puts, this is one of the secrets that not a lot of people tell you. The professional money, the professional people, they use options more than anything. Whenever the average person talks to me about stocks personally, I never get asked about options. And again, not that I'm a professional, I don't consider myself a professional, but that's what the professionals use the most, is options. And that's how I enter almost every single one of my positions. My largest positions are still SPHY, USHY. Those are high yield bond funds, or high yield corporate bond funds. Both of those are at 52-week highs. I have sold off a decent amount, probably about half of each of those, because they're basically at all-time highs. And that has been my strategy for a while. Is I think I had probably 60% my 70% of my portfolio in these funds, and I had quite a bit in the T-bill fund, BIL, which I think I had about 10 or 20% in that, which almost all of it I've sold just because I expect rates to come down. That's been my strategy, and that strategy has worked really, really well. Because I think everybody knows rates are going to go down, and when rates go down, these ETFs, they'll go up in value, and not only that, they're going to pay you 6 or 7% APR while you wait. Again, also, basically the only two positions that I have not talked about is EVVTY. This is a Swedish company, I believe, actually. They operate throughout Europe. They operate like online gaming, gambling, and I think they also run some casinos as well. They basically hit a 52-week low recently, and I picked up a couple hundred shares there. I didn't use options on this one because they are a ADR, and they trade. I think you might even have to buy it over the counter. And again, you can't trade options on over the counter stocks. LVMUY. This is Louis Vuitton. Another one that basically hit a 52-week low recently. I hesitated. I was going to buy it in like the mid 130s, and I waited until the mid 140s to buy it. I still think it's a little bit undervalued where it's at right now. Also, I guess AOS is another one that I recently took a position in. Other than that, basically the same thing. I bought more URA, which is the uranium ETF. I think I bought a little bit more Vici Properties. I wish I would have bought more because my cost basis is below $28 a share. That's basically it as far as that goes. I really like how this is playing out here. This is going it's kind of crazy because I manage this portfolio more active than I manage my actual portfolio, which is kind of weird. But given you have $1.1 million to work with, it's definitely a lot easier to play around with it than an actual portfolio where you have a lot less than that. So that is what I wanted to talk about this week. Any comments, questions, anything like that, please feel free. Also hit that like, comment, subscribe, and stay tuned for more.